Okay, so you want to own a private prison. You picture a guaranteed revenue stream from a government that never stops needing beds, a captive customer base that literally cannot leave, and contracts with the most reliable payer in the world. That's the pitch. Here's the reality sitting underneath it. Private prison companies operate on margins so thin that a single policy change by a single administration can erase years of profitability in a matter of months. In 2021, the Biden administration issued an executive order directing the Department of Justice to phase out its use of private federal prisons. Within weeks, GEO Group and CoreCivic, the two companies that between them control the majority of the private prison market in the United States, watched hundreds of millions of dollars in contracted revenue become uncertain overnight. The customer base doesn't leave, but the contract does. Here's what nobody tells you going in. A private prison isn't a prison in the way most people picture it. It's a real estate and staffing business wearing a corrections uniform. The company builds or leases a facility, hires the guards, manages the operations, and then charges the government a fixed fee per inmate per day, a figure that in 2025 ran to roughly $165 per person per night for ICE detention facilities. Everything between that day rate and the cost of actually keeping a human being fed, supervised, medicated, and legally compliant is the operating margin. And that margin is narrower, more fragile, and more politically exposed than almost any other government contract business in the country. We're going inside the real economics of private prison ownership. We'll build the facility, fill the beds, collect the day rate, and then look at what happens when the contract doesn't renew. First, understand what you're actually buying, because the physical asset is only the beginning of the problem. Modern jail construction now costs between $500,000 and $750,000 per bed in 2026, topping $1 million per bed in high-cost markets. A medium security facility holding 1,000 inmates represents a capital commitment of $500 million to $750 million before a single guard has been hired or a single meal has been served. That capital has to come from somewhere, and in private corrections, it almost always comes from debt, which creates the first structural vulnerability of the entire business model. A fixed capital obligation against a revenue stream that is entirely at the discretion of a government client that can cancel, renegotiate, or simply not renew. The two dominant players in the U.S. market, GEO Group and CoreCivic, figured out a structural solution to the tax side of that capital problem in the early 2010s when they converted to real estate investment trust status. REITs must distribute 90% of taxable income to qualify and are exempt from federal corporate income taxes. That structure allows them to avoid the corporate tax layer that would otherwise eat into already thin operating margins. And it lets them distribute most of their income directly to shareholders as dividends, making the stock attractive to income-seeking investors. But it also constrains how much capital they can retain internally for facility investment and expansion, creating a dependency on external debt markets that amplifies the exposure whenever the policy environment shifts against them. The staffing cost is where the operating model gets genuinely difficult, because a correctional facility is not a warehouse. It's a 24-hour-a-day security operation requiring round-the-clock staffing ratios that don't flex downward when the facility runs below capacity. Correctional officers, medical staff, food service workers, mental health professionals, and administrative personnel have to be on-site continuously regardless of how many beds are filled on any given night. The total annual cost to run a single medium security prison with hundreds of inmates ranges from roughly $6 million to over $12 million, depending on bed count and local labor markets. The private sector's ability to run those facilities more cheaply than the government is the central economic argument for the entire industry's existence. But that argument is shakier than it sounds, because the cost savings often come from lower staffing levels, reduced benefits, and below-market wages that create their own downstream problems in the form of staff turnover, security incidents, and legal liability. That legal liability is a cost category most outside investors dramatically underestimate. A private prison operator isn't just running a building. They're assuming legal custody of human beings, and the legal exposure that comes with custody is essentially unlimited. Inadequate medical care, use of force incidents, deaths in custody, violations of inmates' constitutional rights. Each of these creates potential civil liability that the operator absorbs directly as the party running the facility. The government client that contracted for the facility typically negotiates indemnification provisions that shift as much of that liability as possible back onto the private operator, meaning the company that collects the day rate also absorbs the cost of the lawsuit when something goes wrong inside the walls it manages. Insurance against that exposure is expensive and incomplete, and the reputational cost of a high-profile incident can affect contract renewals in ways that don't show up on any actuarial table. The occupancy model is where the fundamental tension in the private prison business comes into the sharpest focus. A private facility charges a per-day rate per inmate, which means revenue scales directly with how many beds are filled. An empty bed generates zero revenue while still requiring the fixed overhead of staffing, utilities, maintenance, and debt service. Most private prison contracts include minimum occupancy guarantees, provisions that require the government client to pay for a floor of filled beds, even if actual inmate populations fall below that threshold. GEO Group reactivated 4 facilities with a total of 6,600 beds for ICE, expecting those 4 facilities alone to produce more than $240 million a year in revenue. That math works when detention populations are rising. When they fall, the minimum occupancy guarantee becomes a negotiation rather than a guarantee, and the operator bears the fixed cost regardless. The political exposure is the risk that no financial model can fully price. For 2025, federal correctional and detention authorities represented 54% of CoreCivic's total revenue, with ICE alone accounting for 35%. That concentration means a single federal agency's budget decision, policy shift, or administrative priority change can affect more than a third of the company's entire revenue in a single fiscal year. ICE pays roughly $165 a day for each detainee, a rate that looks stable until you consider that it's set unilaterally by the contracting agency and subject to renegotiation at every contract renewal. Private prison operators have no pricing power in the conventional sense. They can negotiate, lobby, and demonstrate cost efficiency, but ultimately the government client sets the rate, and the operator either accepts it or loses the contract. The lobbying machine that has grown up around the private corrections industry is itself a significant operating cost that rarely gets folded into the analysis. Both GEO Group and CoreCivic made $500,000 donations to the 2025 inaugural committee, double what they gave to Trump's 2017 inaugural committee. During the 2024 election cycle, GEO Group employees and its political action committees contributed a total of $3.7 million to candidates, outside spending groups, and other political committees. That spending isn't philanthropy. It's a cost of maintaining the political relationships that keep federal contracts flowing and ward off the regulatory changes that could restructure the industry overnight. It's an expense that goes into every financial model of this business that's being built honestly, and it's one that doesn't appear on any standard operating cost breakdown. So before a single inmate has been processed through intake, before a single contract has been signed, the owner of a private prison is carrying a facility that cost between $500 million and $750 million to build against a revenue model that charges a day rate set by the government, requires minimum occupancy to cover fixed costs, is concentrated in a small number of federal agency relationships, and is exposed to policy changes that can restructure the entire demand picture within the span of a single electoral cycle. That's the cost side of the ledger, and it explains why this industry looks like a guaranteed business from the outside and a genuinely fragile one from the inside. But it raises the obvious question any rational investor eventually has to ask. If the margins are this thin and the political risk is this real, why do these companies keep expanding? The economics of owning a private prison start with why the expansion keeps happening. Because the answer reveals the real economic logic of the private corrections industry more clearly than any balance sheet. The business isn't primarily about running prisons more efficiently than the government. It's about providing flexible capacity that governments can turn on and off without the political and financial cost of building, staffing, and then mothballing their own permanent facilities. When a state legislature decides to crack down on a category of offense, or when a federal administration decides to dramatically expand immigration enforcement, the government's existing correctional infrastructure fills up quickly. Building new public facilities takes years of planning, budgeting, legislative approval, and construction. Contracting with a private operator to activate an existing facility or expand bed count can happen in months. That speed is what the private corrections industry is actually selling, and governments have demonstrated repeatedly that they will pay a premium for it. The revenue mechanics work through two distinct contract structures that create very different risk profiles for the operator. The first is the management contract, where a government agency owns the facility and contracts with a private company to run the operations. The operator collects a fee for managing the facility, bears the staffing and operational risk, but doesn't carry the capital cost of the building itself on its balance sheet. The second is the owned and operated model, where the private company builds or acquires the facility, owns it outright, and leases it back to the government through the per diem contract structure. The owned and operated model generates higher potential returns because the operator captures both the management margin and the real estate appreciation. But it concentrates the capital risk on the operator's balance sheet and creates the deepest exposure when a government client walks away from a contract. The immigration detention market has become the dominant revenue engine for the two largest private corrections companies, and its growth trajectory over the past several years illustrates both the upside and the fragility of the political dependency that defines this industry. ICE pays roughly $165 a day for each detainee, a rate that applies across the detention population regardless of individual security classification, creating a relatively simple per-bed revenue model. GEO Group reactivated 4 facilities with a total of 6,600 beds for ICE. With those 4 facilities alone, expected to produce more than $240 million a year in revenue. At that scale, a single federal agency contract decision translates directly into a $250 million revenue line appearing or disappearing from the company's annual income statement. CoreCivic reported total revenue of $538.2 million during the company's second quarter of 2025, an almost 10% increase from the same period in 2024. GEO Group, ICE's largest contractor, reported second quarter revenue of $636.2 million, a 5% increase over the same period last year. Those numbers look like a thriving business, and by conventional financial metrics they are. But strip away the immigration detention surge driven by the Trump administration's enforcement expansion, and the underlying business is considerably more modest. Federal correctional and detention authorities represented 54% of CoreCivic's total revenue in 2025, with ICE alone accounting for 35%. A company whose largest single customer is a federal enforcement agency operating under a politically driven mandate is not running a diversified business. It's running a highly leveraged bet on the continuation of a specific government policy. The worked case study that makes this clearest is the policy whipsaw that private corrections companies lived through between 2021 and 2025. Because no other 4-year period better illustrates the true nature of the political risk embedded in this business model. In January 2021, the Biden administration issued an executive order directing the Department of Justice to phase out its use of privately operated federal prisons. The immediate financial effect was severe. GEO Group and CoreCivic together saw their stock prices fall sharply as investors priced in the loss of Federal Bureau of Prisons contracts that represented meaningful shares of both companies. Revenue. Both companies drew down on credit facilities, cut dividends, and began pivoting toward immigration detention and community corrections as alternative revenue lines. The Department of Justice contracts began winding down. Facilities sat partially empty. Fixed costs continued running. Then the political environment shifted again. The Trump administration that took office in January 2025 didn't just restore the previous contract relationships, it dramatically expanded them. The value of 3 ICE contracts already received by GEO Group in 2025 for immigrant detention facilities in New Jersey, Michigan, and Texas reached $209 million. The estimated annual revenue CoreCivic will receive from a new ICE contract to build a 2,400-bed family detention center in Dilley, Texas, is $180 million. Companies that had been navigating a managed wind-down 18 months earlier were suddenly being asked to reactivate mothballed facilities, hire back staff they had let go, and expand capacity at a pace that strained their own operational infrastructure. GEO Group's market value reached $4 billion. CoreCivic's reached $2.4 billion. That 4-year arc, from DOJ phase-out order to ICE expansion windfall, is the most important case study in private corrections economics because it demonstrates that the business model doesn't have a neutral state. It's either expanding with political tailwinds or contracting against political headwinds, and the capital structure that made sense during the expansion phase, heavy debt-owned facilities, minimum occupancy guarantees written into contracts, becomes a serious liability during the contraction phase. The companies that survived the 2021 to 2024 period without catastrophic damage did so by maintaining enough liquidity to absorb the revenue loss during the wind-down. Diversifying into immigration and community corrections, revenue lines that weren't affected by the DOJ order, and keeping their balance sheets conservative enough to avoid a covenant breach on their debt when occupancy fell below contracted minimums. The risk that sits permanently underneath all of this, and the one that no amount of lobbying or contract diversification fully neutralizes, is the occupancy risk that emerges when policy changes faster than facilities can be repositioned. A private prison is a specialized asset. It can't be converted into apartments or office space when the government stops sending inmates. It can be mothballed, maintained at minimal cost, and reactivated if the policy environment shifts back. And the experience of 2025 shows that reactivation can happen. But during the mothball period, the operator is carrying debt service, maintenance costs, and minimum staffing on a facility generating zero revenue. The break-even occupancy rate for most private prison facilities, the percentage of beds that need to be filled just to cover fixed costs before the operator sees a cent of margin, sits somewhere between 60 and 70%, depending on the facility's debt load and labor market. Below that threshold, every empty bed is a direct cash drain on the operator. The reputational and regulatory risk layer compounds all of this in ways that are genuinely difficult to quantify, but impossible to ignore. Every high-profile incident inside a private facility, every report of understaffing, inadequate medical care, or a death in custody, creates pressure on government clients to review or terminate contracts that they can point to as having failed performance standards. Several states have passed legislation restricting or prohibiting private prison contracts entirely, and the political coalition pushing for further restrictions has grown rather than shrunk over the past decade regardless of which party controls the federal government. An operator can be running a financially solid facility with occupancy above break-even, a clean inspection record, and a multi-year contract in place, and still face a state legislative session that makes the entire business model illegal within its borders. Put the whole picture together into the real numbers that define this business. GEO Group reported second quarter 2025 revenue of $636.2 million on facilities it owns, manages, and leases across multiple states and federal jurisdictions. Against that revenue sits a debt load built up through decades of facility construction and acquisition, staffing costs that represent the single largest operating expense, and the least flexible in a downturn, insurance and legal reserve costs that reflect the liability of custodial operations at scale, and a lobbying and government relations budget that is a permanent fixed cost of maintaining the contract relationships the entire business depends on. The net margins that result from all of that, in a good year with high federal detention populations and favorable contracts, run in the low to mid-single digits as a percentage of revenue. That is the actual return on a business built around $1 billion facility portfolio and an essentially unlimited liability exposure. So who actually gets rich in the private prison economy? Not typically the company that builds the facility and operates it on a thin per diem margin through multiple political cycles. The consistent winners are the real estate investors who hold the underlying land and buildings through REIT structures and collect distributions regardless of which administration is in office. The legal and lobbying firms whose fees are a fixed cost of the industry's existence, and the operators who time their capacity expansions correctly relative to the political cycle, expanding when enforcement priorities are rising and retaining enough liquidity to survive when they fall. The day rate is real, and during the right political moment, it generates genuine revenue at genuine scale. But underneath the revenue sits a business that is one executive order away from having its largest contracts restructured, one legislative session away from losing an entire state market, and one high-profile incident away from a contract review that makes every other cost in the model irrelevant. Could you get rich owning a private prison? In the right political environment with the right contract mix and the right balance sheet going into a downturn, yes. What you are actually buying is not a guaranteed income stream from a captive customer base. You are buying a specialized real estate asset whose revenue is entirely determined by government policy, whose margins are set by a client with no obligation to renew, whose liability exposure has no practical ceiling, and whose entire financial logic depends on political conditions that can reverse within a single electoral cycle. The beds are always full when the political winds are right. The question is whether your balance sheet can survive until they blow that way again.